Welcome everyone to another episode. In this one, we're going to be talking about something other than GameStop. So I hope that's okay with you. We're going to be talking about a company that most of you are very familiar with. Most people in the world know about the company. In fact, many of you that are listening have been paying this company money every single month. It's Netflix. That's the company. It's one of the most known brands in the world because it's a very simple company. But the simplicity of the brand and the simplicity of the product are misleading because most people, I think, in my opinion, do not understand how good of a company this is, how good of an investment it is. They don't understand how big of a lead Netflix has over its competitors. It's one of the most misunderstood investments in the market today, in my opinion. So what I plan on doing in this video is going over why I think investors They kind of look at Netflix and they don't realize how good of a company it is. I'm going to talk about how dominant of a lead they have. I'm going to talk about how the many competitors entering into the streaming business are not going to really affect Netflix negatively. They're not going to kill Netflix or dethrone Netflix. And I'm going to talk about how I think Netflix is going to be one of the most profitable companies with reliable profits in the future going forward. So this video, we're going to be reviewing all of that, as well as going over all the debate with it right now. With Netflix, there's currently a lot of doubt with this investment. You have a lot of different companies getting into streaming. Of course, we have Disney with Disney Plus. We have AT&T with HBO Max. We have NBC with Peacock and Discovery Channel making their own. And we have all these different streaming companies entering into this business. And that's created a window of opportunity, I think, for investors because there's doubt for Netflix. And that doubt is only going to remain for a short amount of time until people catch on to the fact this isn't going to really negatively affect Netflix. So right now, I consider it kind of a window to be able to look at this company, really analyze it, whether this is going to negatively affect Netflix or not in the long term. So let's get into it. First of all, in my account, the Story Fund, this is my secondary, it's a secondary smaller growth portfolio called the Story Fund. Most of the companies that I focus on have certain characteristics. They're category winners. They have first movers advantage. They're in future-driven industries. They're convenient, easy, simple, highly scalable, and large market cap potentials. Netflix checks off every single thing on that list. It's a category winner, has first movers advantage. Streaming is certainly a future industry. It's convenient, easy, simple. It's the most simple brand in the world. It's highly scalable. Everybody in the world wants to be entertained directly through streaming. And then, of course, I think the market cap of it, I think, is extremely large. So Netflix fits perfectly into these characteristics I'm looking for in these companies. And that's why I've made it one of the top spots, along with some other big bets like, in the gaming industry, I have a big bet. In CrowdStrike, I do, and Salesforce, and a few other companies. Netflix is one of the ones that I have the highest conviction with, and that's what I plan on going over with. Now, before we jump into the bull case for Netflix, I want to go over some of the bear case for it. Some of the people that have been trying to get people not to invest in this company. One of them was just an article from Bloomberg that came out a couple days ago called "This Netflix Analyst Has Cost Investors a 2,000% Return." A 2,000% return, because this analyst has been bearish on Netflix and has instructed investors to not invest in this company since he started covering Netflix like 10 years ago. And Netflix has had a 2,000% return since then. Netflix has been one of the best returning companies in the world for the past, since like 2004 when it was founded. It's returned on average 40% annualized returns. But this analyst has continually instructed people to not invest in Netflix, and he's still doing so today. He still says that Netflix is a bad investment today after being wrong for over a decade. If we go through some of the reasons, he actually talked with Bloomberg and he explained some of the reasons that he was wrong. Most of the blame, he says, goes to Netflix's competitors. So he's not really blaming his analysis. He's saying the competitors didn't do a good job. But I think that criticism that he had back then, or that blame that he had back then, is still applicable today. For instance, he said he thought the big media companies would do a better job protecting themselves from cable TV businesses. That's true. We already know that cable TV loved the money they were making by licensing their best content to Netflix. Like NBC gave Netflix The Office and Parks and Rec and all these great comedy series that people love to just binge watch over and over again. And it got them in this behavior of staying subscribed to Netflix for years. This content was great. NBC is a great content creator, but they had a big miscalculation of wanting to make money now and giving their best content to Netflix, instead of looking in the long term and saying, we're actually building up a huge competitor. They didn't consider Netflix a problem at the start, but Netflix would grow to be now their biggest competitor. Netflix is the behemoth of the industry that needs to be unseated from this position. So that was the case with NBC, CBS, Viacom, A&E, all these companies that are led by people, usually not founder-led. These are hired-on executives that they're looking at their tenure. They're looking at the next year forward, how much money their company can make. They need to hit those quarterly earnings reports. They look so short-term, and they want to make money by licensing it to other people. That's what they did with Netflix. Now, Reed Hastings, the CEO of Netflix, is also the founder of the company. He's the one that started it as a DVD business and fiercely competed with Blockbuster. Once he won the battle against Blockbuster, he didn't just sit there and say, that's great, now we're going to be a DVD business. He saw that things were going to move to streaming, and he got ahead of it before any of these other executives did. He was way ahead of them, and he looked way into the future. He didn't care about next year's return. In fact, if you go to a stock chart and look at like 2006, 2007, when Netflix transitioned to streaming, their stock price plummeted because people were unsure about the transition. But Reed Hastings was very sure about it. He was very confident about it, and that was the right decision. So Netflix currently has a CEO that does not care about next year's, quarterly earnings. He doesn't care about posting a big free cash flow profit next year. What he cares about is being the dominant media company in the next 10 years. The dominant one. He wants the biggest market share. He wants to have the biggest piece of the pie. He's in it for the long game. He's not going to have his tenure replaced in 2 or 3 years. So he's long-term focused. These people at companies like NBC and CBS and Viacom, they're way more short-term focused. I think the only one that also has a better management and a better long-term focus, in my opinion, is Disney. I think they're the only ones that also have a really long-term focused executive team. And that's because Bob Iger, he's the one that also decided to transition Disney into streaming before all these other companies. But it says here that when their shows drew new customers to Netflix and away from cable, they responded by creating services of their own, further undercutting their businesses. So this is another thing you're seeing happening. When companies like NBC create streaming services called Peacock, even if they're gaining subscribers on Peacock, they're likely losing them on their cable businesses they already own. So they're kind of cannibalizing themselves. Disney's dealing with this as well. It's great that Disney Plus is gaining subscribers, but they're also they don't have the same revenue right now in theaters. Netflix is not self-cannibalizing. Every subscriber it gains is just an additional customer at no expense to Netflix. They're not cannibalizing some other business that they previously had. They've been done with the DVD business for over a decade now. So that's another challenge these companies face, is their earnings are going to look poor for a very long time as their revenue goes down because traditional cable's going down, but they're building up their streaming services. With Netflix, the story's much more clean. If you look at the revenue, it's just constantly growing. Then you look at another thing that he outlines. He says, when those media companies did pull their shows, Patcher didn't think Netflix would be good enough to make programs on its own. Clearly, Netflix is good at making content. Now, people will say Netflix has, it has a lot of crap on it. And that's true. But people that criticize Netflix because it has a lot of crummy shows on it, a lot of like reality shows and unscripted television, they don't understand the mechanics of it as good as Netflix. You don't understand streaming behavior as good as Netflix. If you read their blogs and read their developer notes and how they analyze data, you'll see that Netflix knows they need that content. Because there's 2 different categories of content. There's high quality, high production value, the big hits, like House of Cards was one of the first big hits that they made. That was a high quality show when it came out. There wasn't, a lot of shows like that were made with that level of quality. That brings in new subscribers. That's what attracts new subscribers to the platform. But high quality content does not maintain subscribers year after year. What maintains them is stuff like The Office, stuff that can be on in the background as people browse on their phones. A lot of that is reality shows, kind of sitcoms, a little bit less lesser quality shows that people can have on in the background while they're going about their day. A lot of people like having that noise in the background. They like having something fun to watch. Netflix has focused on having both of those. They have a big category of high quality shows. They have shows like House of Cards, Ozark, The Queen's Gambit. They have ones that I think are pretty high quality. But then they also have a category of shows that are really dumb. They're just kind of like unscripted, funny television. People watch both of them. So I think when you're looking at this criticism, it's not true that Netflix can't create good content. They obviously can. And this year, they're also creating a lot of content in movies. And people might criticize that as well, but they have a ton of A-list actors lined up for this year. They have people like Leonardo DiCaprio, to name one. So when you get people like those stars on your platform, you're going to have high quality content that attracts new viewers. Another thing he says is when Netflix's massive output of new shows, he thought the service would always need to spend more and never stop burning cash. The Netflix has too much debt argument was always based on Netflix growth slowing. That's what people always say is now they're going to slow down growing. Now they're going to slow down growing. They're not. They're not slowing down growing. They have been growing since the beginning, and even through 2020, they continue to grow. And then, 2021, that was an outlier year. They have to slow down now? Not the case. Their last quarter, they reported 8.5 million new subscribers. They're growing as fast as new streaming services, but they already have 200 million subscribers. It says, but it was able to rein in spending, aided by the pandemic before the growth slowed. They turned positive free cash flow and didn't lose anybody. They grew revenue and had the astute move of raising prices during this. Suddenly, they are much healthier than I thought. That's another thing that we'll outline later, but Netflix is moving towards free cash flow probably this year. And all that means for people new to picking stocks is Netflix, in order to fund their continued spending on content and on their biggest costs, they will no longer have to go to the debt markets, or they will no longer have to issue new shares or raise money from outside sources. They're going to be able to afford all of their new spending just from their revenue, just from their subscribers, their customers. It goes on, and this guy that's been wrong on Netflix for the past decade, underestimating them, still to this day says that Netflix is not a buy. He says, he outlines one more reason why he thinks that Netflix was successful. He says, with respect, I think they are stupid. He says, they're all public. He's talking about other cable companies. They are all public and have to answer to board members and have to explain why Netflix is eating their lunch. This part, he's true. The other cable companies, again, they're ran by people that are short-term focused. These are people that have constant meetings, have to look at the metrics right away. Reed Hastings, you can tell this guy does not feel any pressure to perform on any metric immediately. He's always long-term focused. They sold everything to Netflix. They got addicted to the earning stream. That's absolutely true. He says the only executive in all of media who has been able to control his board is Disney executive chairman Bob Iger. Also true. Bob Iger had been with Disney long enough that he had the clout to be able to do whatever he wanted. He was able to switch it over to streaming despite there being a lot of internal struggle in the company. Then he outlines what he thinks his target price is for Netflix. He says Patcher, that's this analyst here that's been wrong, he says he believes Netflix will remain the dominant player in streaming for years, commanding a 30% of the market, and yet he still has a sell rating. He increased his price target all the way from $6 in 2011 to more than $300 today. That's still about $200 below where they are trading. I disagree with Patcher completely. I think that as Netflix continues to have the big share of this market, which I think will be much more valuable in the future, Netflix will not be trading at $300. I think it will be trading substantially higher. My price target where I think it will be is more around $800. Now, this article of this analyst that has been wrong for 10 years, costing at least the people that have followed his advice, he pushed them away from one of the best returning investments in the world. He still has the same bearish attitude, and he's not the only one. So I don't want to blame this guy alone. Many people are bearish on Netflix. They believe that the company has hit its peak. It's saturated the market because most people know about Netflix, and it really doesn't have a lot of room to grow anymore. It's going to be one of these investments that underperforms for the next 10 years. And I see that a lot online. I see it in my Discord amongst other investors I talk to. I can look at a couple examples. For instance, just on Seeking Alpha, we have articles out this month. Netflix will soon meet the law of diminishing returns. His whole article is explaining that Netflix is no longer going to be the same company it was. It's already hit its max size, and these competitors coming in, They're going to hurt Netflix. We have ones like this. Streaming price war approaches. Sell Disney and Netflix. So if you listen to this analysis, you would say, well, I'm going to sell the two companies that are probably going to be the biggest streaming winners over the next 10 years. In my opinion, that's very poor advice. We look at this. Netflix, temper your enthusiasm. This is the type of articles that we're constantly getting, and it's not just on Seeking Alpha. We can also look at another example. This is out in 2019. Netflix must add ads or lose millions of users, Needham says. So we have professional analyst firms saying to Netflix, hey, you guys, you need to add ads into your business. Pretty much telling Reed Hastings he doesn't know how to run his business. It's been ad-free since the beginning. It's been the dominant player. I think if they followed analysts like this, it would be a total mistake. I think Netflix and the owners of this company, Reed Hastings and the people running it, I think they know much better about their customer and about their business than analysts do. So this is the issue with listening to analysts like this. I think it pushes you out of great investments, just like this guy had pushed his, the people that follow him out of Netflix for the past 10 years. Now I'm going to be going over a couple pieces of analysis. One thing is just the Netflix shareholder letter. So we'll be going over that. And another thing is this write-up from a hedge fund. I know they're the big bad things right now, hedge funds. In my opinion, there's many good hedge funds, by the way. But this one is actually a Brazilian hedge fund, which was exciting because they first started off investing only in Brazilian companies. Now they invest in international companies. And they did a write-up about Netflix. This is a recent write-up about it. And they outline many of the arguments that I feel about Netflix. So I've read through a lot of information about Netflix, a lot of different articles from different hedge funds. And this one summarizes many of the points. So we'll be going over this as well. But first of all, let's look at the shareholder letter. This is from the last quarterly report. I can highlight just a couple of things. First of all, the amount of new paid subscribers continues to grow. And this is the point that a lot of people miss. Netflix will continue to grow. It won't be perfectly linear. They might have some months where it declines in the US because it's mostly saturated, but there's a lot of people out there. People forget that the US is not the only place in the world. You have all of Europe, you have all of Asia, you have India, you have South America, you have all these different markets. Even in Africa, wherever they're getting internet, wherever there's a household that has internet connection, they can sign up for Netflix and they will have content there that they'll enjoy. So you're going to see this expand over time. There's right now about 800 million households that currently could sign up for Netflix. They have internet, they have the capability and the money to sign up for Netflix. Most of them are using old traditional means of entertainment. So as you see that switch over, we're still going to see continued growth with Netflix subscribers. This is what you're seeing on this graph. You can see that in 2017, it grew pretty steadily. In 2018, it grew steadily. In 2019, in 2020, it didn't grow steadily. It grew kind of exponentially when the pandemic happened. Everybody that was sitting at home getting stimulus checks needed to do something. Netflix was the thing to do. They had Tiger King come out, and that drew in probably millions of new subscribers. They had record-breaking quarters, getting what? 25 million new subscribers in one quarter. And then the amazing thing is their growth kind of tapered out for a bit, but then it continued right along. In the end of 2020, it picked back up, and then 2021, it's still projected to be growing at the same pace. So even though they had record-breaking growth, it didn't really slow them down all that much. This is the amazing thing about it. But this also highlights another important thing, that Netflix, when other companies were panicking and going through this terrible event, Netflix benefited from it. That's another sign of a great company. One that even during recessions, a pandemic, a depression or something like that, Netflix continued to do really well. It's one of those companies that succeeded. Then we can go down and we can focus on content. This is a big point that Netflix is competing with, obviously all the new subscribers. They say big growth in streaming entertainment has led legacy competitors like Disney, Warner Media, and Discovery to compete with us in new ways, which we've been expecting for many years. They're not bluffing when they say that. That's why they went into streaming. And then not only the short-term thing would have been just to license other people's content forever, because it was easy to do. It didn't cost them a lot of free cash flow to do that. But what they did was they were forward-thinking and they started investing heavily in original content. That's what they say when we've been expecting for many years. This is in part why we have been moving so quickly to grow and further strengthen our original content library across a wide range of genres and nations. So Netflix knew that the competitors at least the cable companies would wisen up and see the competitor that they're growing, Netflix, and they would eventually want their content back. And they would try to starve Netflix of their best content. So they got ahead of that by creating original content. And now they have production companies, they have a network of producers and creators all around the world that they can go to create content. The cost of creating content is going to go up because now all the competitors are investing heavily in it as well. But Netflix, I think, already has this figured out. This isn't a new business for them anymore. They are a massive content creator. It goes on explaining the different type of content they're going into and all these great shows they're creating. Again, a lot of people can criticize their content they make, but look at the amount of Emmys and Oscars that Netflix gets nominated for or wins. Sometimes they're the most winning producer out of any of them. So they do create some good content. Here it shows Google Year Search in 2020 global. Under TV shows, we have Tiger King is number 1 in 2020. Of course, that was a crazy, odd documentary. Then we have one show that's not Netflix, Big Brother Brazil. And then every single show on the list in TV is Netflix. That's how popular and viral Netflix is in the globe. Out of the top 10 most searched shows in 2020, Netflix was the producer of 9 of them. Movies is where they're lacking. Out of the top 10 movies, Netflix only occupied 2 on that list. And that is what they are moving into. They are investing heavily into movies. They want to make it so they're the top 10 on this list as well, 9 out of 10. And if you look at their movie lineup, they have a huge lineup of movies. Again, you have people like Leonardo DiCaprio, they have The Rock, they have Ryan Reynolds, and other big name actors that will attract an enormous amount of attention. So Netflix continues to go on. They say in this that they're moving to free cash flow positive this year. Again, meaning that they're not going to be able to, they're not going to have to go to the debt markets. And I think that they're in a very good position. But their big investments, they're going to continue with TV shows, but now they're investing very heavily into movies. But let's go ahead and move on to this research from IP Capital. I'll go ahead and open it up on the iPad so you guys can follow along. Okay, so let's jump right into this research. Again, this is from IP Capital Partners, and they're a hedge fund in Brazil, and I think their research is fantastic. That's why I want to reference some of it here. So let me go through. I've read through this a couple times, as well as a few other hedge funds. But they outline first kind of the situation with the coronavirus, and they outline the differences between the companies that thrived during this challenge and the ones that really struggled. And they basically said, this is why they focused on higher quality businesses, because they say it's a common market perception that to obtain superior returns, great risks must be incurred. But that's not really the case that we've seen. The companies that have been the bigger companies that have better business models and they're better businesses overall, guess what did good during market volatility when everything went down in March of 2020? Those companies, the ones with superior business models. They say in the long run, these discounts, these are of the poor business models, rarely outweigh the dangers of investing in lower quality businesses. And I agree with that. That's why part of the shifts that I've been making with my portfolios is I'm less looking at the companies that are trading at a discount, that have business models I don't like, and I'm trying to find the best companies, the ones that have the best business models, that those are trading at a discount because of a lot of misconceptions and a lot of disagreements. They say sooner or later the risks materialize and claw back any previously attained returns. That's with cheaper companies trading at a discount. Instead of incurring high risks and aiming for high returns, the key to long-lasting investment success is to find idiosyncratic situations that combine a small risk of permanent loss and a high potential for returns. This is the sweet spot we search for. I agree with this. When I look at Netflix, I look at a company that I think over the next 10 years, I have an incredibly low amount of chance of losing money on it. There's always a chance. That's the case with every investment. You can look at any that, they seem like a sure bet, and there's examples of companies that have had something wrong. So if Netflix was doing something like committing fraud or there's some big scandal or something, it might affect it. But overall, Netflix is one of these companies that they're highlighting. It's a high quality business model, much higher quality than most companies that exist. It has a huge potential market. The TAM on it, the total addressable market, is gigantic. And the revenue stream that they're gaining is extremely reliable. It's rare to find a business that has all those ingredients. A reliable revenue stream, founder-led, long-term focused, huge addressable market, lots of tailwinds behind the company. So those are the type of things that they look for. Now, they go into Netflix specifically here. This is what I want to highlight, a few things, and I'll just summarize this, but they go through the cable TV industry and give a brief background on it. And a lot of people's question now is, why are there so many channels on cable television? Are there really people watching all these different channels? They explain how this happened. They say, let's see, it's right here. The cable bundle soon became pervasive. This is the cable bundle. The economic logic was, if consumers have different tastes, a single monthly plan that met almost all preferences would benefit both consumers and content providers. Growth was explosive. In 1980 alone, 20% of American families had paid TV subscriptions. By 1990, so 10 years later, the penetration reached 60%, and in 2010, 9 out of 10 families paid for the bundle. That is an incredible amount of growth. In 1990s, a broad flexibilization of the regulatory framework led to more consolidated sectors where TV networks had ever-increasing bargaining power over their operators. So this led to where there was a couple channels that people actually did like and they watch, and the cable providers used that to force consumers to pay for numerous channels they really didn't like. ESPN's strength helped Disney secure the distribution of less popular channels such as the Disney Channel and ABC Family. This dynamic occurred with the whole industry. CNN, which was a popular channel, helped Time Warner distribute the Cartoon Network. MTV and Nickelodeon carried Viacom's less popular channels, and so on. The result was a meteoric growth in the number of channels offered with the bundle, which resulted in remarkable transfer value from customers to the pockets of TV networks. From 1980 until today, the average cable TV subscription increased from $15 to $100. Look at the price of Netflix. Right now, Netflix, the base plan is about $9 a month in the US, and that can be shared amongst 2 different people. So 2 families can enjoy Netflix ad-free for $9 a month. Compare that to cable TV. That's not direct to consumer. You have to watch an enormous amount of ads. About 20% of the time is ads. And it's $100 a month, and you can't share it amongst other people. This is the value difference between Netflix and traditional cable TV. They said that it increased well above inflation. In 1999, the average cable customer paid for 50 channels and watched only 13. 15 years later, the same subscribers who now watch 18 channels on average financed over 200. That is the value that you're getting when you sign up for cable. You're paying like $80 to $100 to finance 200 channels, and you probably watch maybe 18. You look at what this has caused, and they say channels watched per household continue to decline. Channels received per household continues to go up. So people get more and more channels, even though people are watching less and less channels. They say that asymmetry was made possible due to the control the TV networks exerted over distribution of the content for the past decade. So this wasn't something that was consumers' choice. They say, as in several other industries, the internet subverted this competition advantage, paving the way for distribution of these business models, or disruption of these business models. The consumer habits of the American market are a good indicator of what's to come in 2019. A cable TV provider spent, on average, 24% less time watching television than in 2010. This decline was even greater for consumers under 34 years old, decreasing by over 50%. People are watching less and less cable every single year, while consumers between 12 and 17 reported an incredible 64% drop. So younger people, I think, not even just Netflix, they look at YouTube more, they're looking at TikTok more, all these other like Twitch and different things. And I think cable is just gone. Cable is not going to be a thing at all in like 10 or 15 years. I think it will be completely dead. And you can see the gradual decline of it. Even when, being a YouTuber, I keep track of everybody coming onto YouTube. And I can clearly see that YouTube is growing like crazy. You have cable news network anchors that are creating their own YouTube channel. You have people like Megyn Kelly that are like, cable TV is not even going to be a real thing in enough time. So they're all creating their own YouTube channel, and now they're on the same level with YouTubers. But the reduction in cable is going to lead those subscribers to sign up for other production companies. That's where Netflix comes in. They highlight the change in time spent watching cable TV per month by age. You can see that it's decreasing by every age group, but most of it's in 18 to 24 and 12 to 17. So people around this age right here, They have watched less by far, and that's good. It's younger people. Again, this is in the future. The people that are a little bit older, they are probably going to still stay with cable, but that's okay. You're looking at the growing market. That's what you want to be investing in. And then it goes on with Netflix. This is where we get to some stuff specifically that I'll outline. In the US, the average TV subscriber watches about 4 hours of content per day. That seems like a lot, but that's true. If you actually track like your screen time on your phone or what you're doing, you watch a lot of content per day. And as previously mentioned, pays about $100 a month for its cable plan, which equates to 83 cents per hour of content. 83 cents per hour. On the other hand, a Netflix subscriber watches on average 2 hours a day. And of that content, they pay about $13 a month for the service, which corresponds to 22 cents per hour. If they have the $9 plan, they can pay even less than that. But 22 cents per hour compared to 83 cents per hour. In other words, Netflix charges 70% less per hour watched while offering a superior service. And I'll note, ad-free. Netflix also doesn't have ads. The value proposition between Netflix and the other things that people are watching is much better. Netflix, which launched its streaming service over 13 years ago, in January of 2007, in a subscription business model, that means that even before accounting for other competitive advantages, the company already starts off with lower churn than other potential competitors. This is something a lot of people don't know about, but if you look at the churn rate for a subscription business, as the business grows and matures, the churn rate goes down. And this is what they're highlighting here. They say that the company already starts off with a lower churn than potential competitors. Barry McCarthy, the current Spotify and former Netflix CFO, explains, as the average tenure of subscriber base increases, the average churn rate falls. So if you and I both are competing subscription businesses, and yours is older than mine, then even if your services are equally liked with exactly the same churn curves by customer cohorts, your average churn rate will be lower than my average churn rate, which means that more of your marketing dollars are going to support new subscribers and more of my marketing dollars are going to replace churn subs, which means you can grow faster than I can, and beat me like a drum. So he's saying that, if you're trying out a service for the first time, there's a good chance you might cancel within the first 2 months because it's new to you, you're trying it out, you're not really a locked in customer. So as these new companies come in, like Discovery, like Peacock, they're posting these big numbers, but they're going to have a much higher churn rate than Netflix because people like me signed up for the Peacock service. I haven't paid them a dime. And then I watched a couple seasons of a show and then I asked for money. And I thought, well, I already have Netflix, so I really haven't watched much of it. But I'm going to be reported in that 33 million that signed up for Peacock, right? This big number. But they're going to have an enormous amount of churn that Netflix doesn't have. Most of the people subscribed to Netflix have been with the company for 5+ years. I've been with Netflix for 10 years, been a customer of it. So I don't plan on being in those churn numbers. I'm not going to be canceling Netflix. I like the product. And the longer these people are with it, the more likelihood of them continuing to have a lower churn. I can even see that with my Discord, right? I have the Patreon membership. If 100 new people sign up, some of them will leave instantly. They'll try it out and they say, oh, this isn't kind of what I was expecting, so they'll leave right away. But as it matures over time, the churn rate continues to go down because the subscribers, the Patreon subscribers that have already been a member, a lot of them really enjoy it and they end up staying for month after month. So you see this with every type of subscription business model. Once the company matures like it has with Netflix, they're going to enjoy investing most of their money into content, not trying to keep current subscribers. This talks about a flywheel. So a virtuous growth cycle. There are important virtuous cycles boosting Netflix's growth. Netflix subscription revenue finances its content investment, which attracts new subscribers, while also increasing the satisfaction of existing subscribers, creating a positive feedback loop. Ted Sarandos said the company's chief content officer puts it more clearly: more shows, more watching, more subs, more revenue, more content. That's the big circle that goes around. As Netflix gains more subscribers, that gives them more revenue to pump into more content and better content. And better content attracts more subscribers, which gives them more revenue to pump into better content. Other companies that are starting this off, it's like a snowball. The other companies are in the very early stages trying to push this along, and they're cannibalizing their previous business at the same time. Netflix already has this giant avalanche, right? It's no longer a snowball. They have an insurmountable lead in this. Their virtuous circle here is huge. They have so much money, so much revenue every month that they can pour that back into content. So it says, at the same time, the growth in subscribers makes the platform increasingly attractive place for content producers who realize that Netflix offers the possibility of gathering an unrivaled global audience. And you've seen this before. You can highlight example after example of TV series that have been flops on traditional cable news network because there's no virality there. But once they're placed onto Netflix, all of a sudden they're these big hits. They highlight one here. There are plenty of examples of utter audience failures that became instant hits after launching on Netflix. Take, for instance, the case of the psychological thriller You. That's the name of the show. The series produced by Lifetime failed to achieve 700,000 daily viewers and was canceled after its first season. That's true. I didn't know about the show You and when it was on Lifetime or whatever that network is. Had no clue about it, never heard about it, probably would have never heard about it. That show and the actors in it, they would have just been lost in history at that point. It says Sarando is always vigilant, purchased the right, and quickly launched it on the platform. So their content guy saw, this show failed, but maybe it won't fail on our platform with the way that we work. So he purchases the show. He says he was right. It had immediate success, reaching over 40 million viewers in less than 4 weeks. It wasn't even reaching 700,000 views, but on Netflix, in less than 4 weeks, it received 40 million views. And then it talks about the visionary leader. This can't be highlighted enough. I mean, I could go through and summarize it and talk about Reed Hastings, but again, it's all about mentality. He is very long-term focused. So if you're investing in Netflix, you're investing in part in Reed Hastings, who is the founder-led CEO that's grown the company to this size, competing with these other big cable companies. So he's the one that you have in your corner, which I think makes the job of the investor much easier. You're investing in a great company, the dominant leader with a CEO, an executive team that you can count on to really protect your long-term returns. So Netflix, they're not really a technology company anymore, in my opinion, but that doesn't go to understate their technology completely. They have a lot of things on their platform that other ones don't have. Like they have better ways of managing user data in the form of streaming. So they have something called a dynamic optimizer. Not only optimizes the transmission quality according to the connection speed, but also modulates scene-by-scene compression to minimize buffering. This is the type of stuff that takes time to figure out. Netflix has had to do a lot of testing to get their service to the point where it is now. They say A/B testing that dynamically switches the cover arts for each title to maximize conversion. Can you see what Netflix is doing there? That's what some YouTubers are doing. If you look at some YouTube channels, they might launch a video, and if it kind of lags where their last 10 videos have been, they have another thumbnail that they'll switch out and see how that does, if it attracts more clicks to the video. Because they might say, well, the content's good, but this thumbnail is not attracting attention. Well, Netflix has A/B testing that they'll show to millions of people and see the click rate through their shows, and they can switch that on the fly. So they're doing these type of algorithmic things to make it so that you're more likely to click on their shows. They say a list of functions precisely designed to remove all friction from user experience, recalling where the viewer last stopped, allowing viewers to skip the introduction of credits, automatically starting the next episode, vertical trailers for mobile users, new formats such as the launch of interactive content that allows a viewer to influence the narrative's direction. The list could go on. It is reasonable to assume that the more observant competitor will attempt to copy these technologies, but the acquired lead is relevant and serves to accelerate Netflix's growth. So all these other companies are going to try to do this, but they're not always as good. You think that Amazon is a tech company, right? They're probably one of the companies that has the most developers of any company, right? They're right up there with probably like Microsoft and Apple. Look at Amazon's Prime's interface on various devices, compare that to Netflix. And you can very much tell that Amazon Prime Video is just one little portion of their overall business that gets paid attention to as one little portion of their overall business. They share different goals. Netflix is solely focused on Netflix. Amazon is focused on a million different things. They're focused on AWS and Twitch and third-party sellers and Amazon Prime Video and Amazon Music and so on and so forth. So if you compare the two together, you can clearly see the difference. Now, here's another thing I want to highlight with Netflix. It's the global content production platform. One of the criticisms of Netflix, or at least one of the things people bring up when they doubt Netflix is, well, they created content for the US, but how is that going to appeal to the rest of the world? Netflix started off creating content mostly focused around their US consumers because that's where they grew up. But what we've seen is that people like content from other cultures and other people. They enjoy viewing that. If you look at even Disney's content, it has huge, massive appeal in India. India, they love Marvel, right? They love Disney's content. It has global appeal. And we see that in lots of different communities and lots of different places with Netflix. The ability to create local content with global appeal is another key aspect of the company's competitive advantage. If I go up here, it says, in some cases, like the drug trafficking drama Narcos, it is even difficult to determine the country of origin. The series was created by an American, filmed by a Colombian, the main actor is Brazilian, the dialogue is in Spanish, and it is an absolute success in Germany. That's what I mean by content can appeal to a lot of different people. So I would not be concerned about content appealing to places that Netflix isn't exactly saturated in right now. It's going to appeal to them. People enjoy good stories. Netflix is one of the companies that creates a lot of good stories, and so I think they're going to continue to have demand. If we look at the streaming wars, this investment firm, this hedge fund, says that it's a false narrative. I've also said that. That's why I highlighted that right here. I've been saying this for a long time. If you look at my videos on YouTube on Disney, I have like a playlist of them, and I've said many times, Disney is not going to kill Netflix. Even if it passes up Netflix in subscriber count, that won't be dethroning Netflix. There's a lot of different metrics you can look at. So I agree with their research. I think that Netflix is not really part of a streaming war. There's a streaming war to some extent. I don't think that every new streaming company is going to be very successful. That's not my feelings. I don't think that the pie is so big that all these random smaller ones are ultimately going to succeed. In fact, I think if they fail, they will license their content and sell it to bigger streaming platforms. So a lot of the failures will end up on Netflix. They'll just have licensed content, or they'll end up on like the Roku channel or something like that. That's where it's smaller, channels that people aren't really going to start paying for. There's going to be a handful of really big winners like there was with cable. And the value proposition is going to be much better than cable. I definitely think that Netflix is still one of those winners now, but I think it will be a huge winner 5 years down the road. So much so that it will be undeniable the market power they have. To give you some thoughts or further data on this streaming war phenomenon and how I think it's a false narrative, I have on my YouTube page, this is a poll that I did 5 months ago. I have this on the YouTube community page. It's like a kind of a Twitter feed on YouTube. So if you're subscribed to the main channel, you'll see this show up from time to time. If you could only pick one streaming service, which one would it be? That's what I asked. And I gave 5 different options. It got 8,000 votes, which is a meaningful amount of people, right? That's a lot of respondents. It says Apple TV Plus, 2%. So Apple TV Plus is not a must-have by any means. People don't view that as a core streaming service. Amazon Prime Video, though, they've been around a lot longer than Apple TV, and that one's only at 7%. And then Disney Plus, this was after people got a piece of The Mandalorian, it's still only 9%. HBO Max, 7%. Netflix, 75%. 75% of the respondents said that they would cancel Netflix last, that it would be the one streaming service that they would choose to keep. This is evidence in and of its own. People are not going to cancel Netflix so that they can watch HBO Max. They'll just subscribe to both of them. And if they're going to cancel one out of the two, it'll most likely be one of these other streaming services. They might cancel Netflix for a while, but usually they come back to it after a while. So I think there's strong evidence to show that the streaming war is kind of a misguided concept. In these type of businesses that are highly scalable, it's not winner takes all, it's winner takes most. And I think that Netflix will be one of the companies that will continue to be one of the biggest. It won't take the entire industry, but it's going to be one of the biggest winners in this industry. And I think people are going to want to own a piece of it. And we see Apple. grow bigger and bigger and opening up this marketplace of phones, and they kind of control a huge portion of it now. And after it's grown big in size, people still want to own it. After it's grown to $1.5 trillion in size, the media category is massive. It's only growing. Old cable companies still hold a huge portion of it, and they're bleeding right now. They're bleeding subscribers every year. It's a gradual decline. They're declining 2 or 3% every year, and Netflix is gaining all of those subscribers. So this is a company that you can tangle with the valuation on it. People could say, well, it's ran up a lot in price. Is it still a good buy? I'm not as concerned about trying to time these buys. I'm trying to identify the best companies in the market, and then I want a dollar cost average into it. In most great companies in the past, if you go back and you read articles 5 years ago about Apple, Amazon, Netflix, any of these companies, Google, people will tangle over the valuation. And if they would have just forgot about the valuation a little bit, and as long as it's somewhere reasonable, they dollar cost average into those companies, they would see the tremendous growth that it had now. I think that whether Netflix right now is trading at $500 or $400 or $450 or $550, I think that's all going to be cheap in 5 years. I think the company will be trading above $800 a share. So anywhere you're buying it right now, as long as you're long-term focused, I think that this will resemble a cheap price ultimately. So you can go through and try to buy the dips and buy it at different times. But my plan is to just dollar cost average into it and hold on to it, because I think that this red, over time, it will turn to green, and it will turn deeper and deeper to green. And I think that Netflix over the next 5 years will be a market-beating holding. I think it will outperform the market. So that's some of my thoughts on it. I could continue on, but this video would be 3 hours long. So I wanted to give a little bit of a summarized version of it. But that's my investment into Netflix. If you want to look at more detailed analysis on all these different companies, you can check out the Patreon. It's in the description. It helps support the channel and helps support me doing this. So I appreciate everybody that's part of that. Other than that, I'll talk to you guys next time.